Hello and welcome to another video by iPassTheCPAExam.com. My name is Haley Lawson. I'm a CPA and accounting instructor. Today I'm helping Stephanie, the creator of iPass and the published author of the CPA exam guide, explain the first in, first out, commonly known as FIFO, inventory cost flow assumption. So what is a cost flow assumption? A cost flow assumption is something that's used by a company and it assumes that inventory moves in one way or another. And it assigns costs based on these assumptions. So I've said assumption a lot, right, in the very beginning of this, and that's exactly what it is. So the cost flow assumption that's used by a company will not actually mimic the physical flow of goods. So in accordance with US GAAP, the inventory cost flow assumption, the key objective is for the company to utilize a method that clearly reflects their periodic income. So for most companies, it's difficult, or if not impossible, to track each specific cost that's associated with an item. So that's why there are many assumptions that can be used to determine the most appropriate cost flow factors. These assumptions include first in, first out, FIFO, which we'll discuss in depth later, last in, first out, LIFO, and average cost methods. So it's completely up to management to choose the most appropriate cost flow assumption, but FIFO best reflects the physical flow of inventory. Let's chat through an example so that you can understand why that might be. So suppose you're in the grocery store and you want to buy bulk coffee beans from the dispenser. As you dispense the beans into your bag, those that fill your bag first are the oldest beans in the container. So like most other companies, grocery stores really want to sell their oldest inventory first to prevent spoilage. So this is really consistent, and I think it's a really great visual of the first in, first out cost flow assumption. So the FIFO inventory method assumes that the oldest inventory items are sold first. So the oldest coffee beans were the ones that were put in first, and we're assuming that those are the first ones that will be sold. So to calculate FIFO cost of goods sold, you begin by determining the cost of your oldest inventory. And then you multiply this cost by the number of inventory items that are sold to determine the cost associated with the sale of inventory. The process for calculating the cost of goods sold using FIFO depends on whether the entity uses a periodic or a perpetual inventory system. So under a periodic inventory system, the quantity of inventory is generally determined through a physical inventory count that occurs on an annual basis. Usually that's at year end. So let's go ahead and chat through how to calculate cost of goods sold using a periodic inventory system. So you can see we have our formula on the screen here. We have beginning inventory plus purchases equals goods available for sale minus ending inventory. As I mentioned, that is generally from a physical count, and that will equate to cost of goods sold. So algebraically speaking, if you wanted to kind of mix this equation up and solve for ending inventory rather than cost of goods sold, you can take goods available for sale and subtract cost of goods sold to arrive at ending inventory. So that would be in case a physical count was not actually performed for the year. I really think that this is best understood through an example, so let's go ahead and look at this one. We have Candle Corporation, who is in their first year of operations. They've purchased 2 batches of inventory throughout the year. Batch 1 was 3,000 units and $1.25 per unit, and then batch 2 was 6,000 units and $1.75 per unit. 2,000 units were sold after the first purchase, and 5,000 units were sold after the second purchase. So we're going to go through and determine the cost of goods sold and the ending inventory for Candle Corporation in year 1. So we'll begin by first calculating the goods available for sale by taking beginning inventory, which is 0 because they're in their first year of operations, they don't have any inventory to begin with. And then we'll add our batch 1 and batch 2 purchases. That'll give us a total goods available for sale of $14,250. So you may be thinking, we haven't really applied anything with first in, first out, and you're completely right. Goods available for sale will be consistent between FIFO and LIFO and weighted average, because we're not really applying that cost flow assumption yet. We're applying it when we're determining the cost of goods sold and the ending inventory, which we'll do next. So assuming that we sell our oldest goods first, because we are using the first in, first out assumption, we want to sell all of our goods from batch 1 first. So we will assume that we've sold 3,000 units, which is our entire batch, from batch 1 at $1.25 each. And then, because we sold 7,000 units in total, we're going to have 4,000 units remaining that we will subtract and take from batch 2. So we'll have 4,000 units at $1.75 each to give us a total cost of goods sold for the period of $10,750. Now, what would ending inventory be? We're simply going to take the goods available for sale of 14,250, subtract the cost of goods sold that we calculated of 10,750 to arrive at ending inventory of $3,500. So what if a perpetual inventory system were used? In a perpetual inventory system, the record for inventory is updated with each purchase and each sale that occurs. So because of this, you're able to determine the actual cost of goods sold with each sale because there's a running total that's kept for that inventory balance. So we're going to go ahead and assume the same facts as before. Candle corporations in their first year of operations, they've purchased 2 batches of inventory throughout the year. 2,000 units were sold after the first purchase, and then 5,000 units were sold after the second purchase. So we'll go ahead and determine cost of goods sold and ending inventory using perpetual FIFO now. I think it's easiest to calculate ending inventory and COGS using a table that really breaks down each transaction, and that'll kind of help you to understand how the inventory is perpetually tracked. So that's why you'll see this kind of in a table form on this slide. So we'll show that we have our batch 1 units purchase of 3,000 at $1.25 per unit, and that will equate to a change in inventory, which will increase inventory by $3,750. So after our batch 1 purchase, we'll have a balance in inventory of $3,750. As you know, we sold Candle Corporation sold 2,000 units after that batch 1 purchase. So because we're going to use perpetual and because we are kind of maintaining this very ongoing record, we're going to go ahead and take those 2,000 units from our oldest inventory. That's the 3,000 units purchased at $1.25. So because we sold 2,000 units, we will take 2,000 times $1.25 to arrive at our change in inventory, which will decrease inventory by $2,500 from that first sale. Now we'll have a balance in inventory of $1,250, and we'll have a cost of goods sold of $2,500. Batch 2, we purchased 6,000 units at $1.75 each, and that resulted in an increase in inventory of $10,500. So now the balance in inventory is $11,750. Lastly, there was a sale of 5,000 units, and that was after batch 2 had been purchased. So this is where the cost flow assumption for FIFO is really going to come into play. We are going to assume that Candle Corporation sold the oldest units first, so they had 1,000 units remaining from their batch 1 purchase, which is why we're going to allocate 1,000 units at $1.25 for this sale, and then the remaining 4,000 units will be assumed to have been sold for the $1.75 cost per unit. So that will give us a total change of $8,250, which will decrease inventory, and that will also be our cost of goods sold. And now we'll have an ending inventory balance of $3,500. So in total, throughout the period, total cost of goods sold is $10,750, and then total ending inventory is $3,500. So, as you can see in these examples, both the ending inventory and the cost of goods sold are the same, whether a periodic or a perpetual inventory system is used for FIFO. So now let's talk about the impact that FIFO has on gross profit. So generally, FIFO has the highest gross profit during a period of rising prices. You might be wondering why this is. It's because when prices are rising, the company is selling their oldest, which means their cheapest, inventory first. So gross profit is calculated as revenues minus cost of goods sold. So during a time of rising prices, FIFO will result in the highest net income because they're allocating the lowest cost of goods sold. I think it's really helpful to see this in action through an example. So let's take a look. Let's assume the following transactions related to Pretty Profits Corporation during a period of rising prices. So January 1st, Pretty Profits purchased 1,000 units for $250 each, and then on June 1st they purchased 2,000 units for $375 each. On November 1st, they sold 1,500 units. First, we'll go ahead and determine cost of goods sold. So assuming FIFO, we will go ahead and say that we sold 1,000 units at $250 each, to use up our oldest inventory first, and then we'll take the remaining 500 units and multiply that by 375, because those are from our newer purchase, and that will give us a total cost of goods sold of $4,375. So suppose revenue on the sale was $10,000, that means that gross profit would equal $5,625. So you're not able to really see the impact of FIFO during rising prices yet, but we're going to use this and compare it to a period of falling prices next. So now let's see what it would look like if Pretty Profits were operating during a period of falling prices. So January 1st, they purchased 1,000 units for $375 each. June 1st, they purchased 2,000 units for $250 each. And then November 1st, they sold 1,500 units. So now, cost of goods sold is going to equal $5,000 because the oldest inventory that's assumed to be sold first is more expensive. So you can see that FIFO accounting during a period of rising prices is going to create a higher gross profit, whereas FIFO during a period of falling prices will create a lower gross profit, as you can see that gross profit here is now $5,000. So, do you think that the use of FIFO or LIFO or any of those cost flow assumptions have an impact on income tax expense? The answer to that is yes. So because FIFO results in a higher net income during periods of rising prices, it also results in higher income tax expense. Conversely, if LIFO were used during a period of rising prices, it would result in lower net income. So there's a direct correlation between net income and income tax expense, and you really want to make sure that you keep this in mind when you're trying to really understand and determine the tax implications of both FIFO and LIFO. So what if a company wanted to switch from the FIFO method to the LIFO method? It can create pretty significant changes in their financial accounts. As I just mentioned, the income tax expense alone will vary depending on whether FIFO or LIFO is used. So if a business decides that they want to switch from FIFO to LIFO, they may have to restate their financial statements to reflect the changes of that new method. Financial statement users want to be able to compare and contrast financial data year over year, so that's why it's really important for those financials to be restated. In very few cases, but sometimes, it's not practical or it's pretty impossible for the company to determine the impact of switching from FIFO to LIFO. If that's the case, they need to make sure that they include a disclosure within the financials and then apply that method moving forward. Kind of touching on the differences between FIFO and LIFO again, there's something called the LIFO reserve. Every once in a while you'll hear to it referred as the FIFO reserve, and that was something that was created to keep track of the differences in accounting for inventory using the FIFO or LIFO method. So, as we mentioned earlier, the FIFO method really closely mirrors or mimics the actual flow of inventory, so many companies use that method internally. But because LIFO results in lower income tax expense and everyone wants to pay less in taxes during periods of rising prices, most companies opt to use the LIFO method to report their financial performance externally. So to calculate the FIFO reserve and the LIFO reserve, you take the difference between the FIFO inventory and the LIFO inventory. Having a really thorough understanding of the FIFO method is so important for passing the CPA exam, so be sure to check out ipassthecpaexam.com for more information, and don't forget to subscribe so that you never miss one of our videos. And best of luck in your studies.